Good morning from London. I'm Anna Edwards alongside Kriti Gupta and Lizzie Burden. We're an hour away from the opening trade. Here's what you need to know. Mercedes running out of gas. The German car maker sees profitability fall well below its own targets amid heightened global competition and dipping Chinese demand. In other earnings, drug maker Sanofi gets a vaccine boost while Eni cuts guidance on weaker oil outlook. We will break down the latest figures from Natwest. Plus, Barack Obama and Bruce Springsteen joined Kamala Harris to rally voters in Georgia, while Donald Trump targets Arizona and Nevada. We will have the latest.
Let's check in on these markets. It looks like it's going to be a lacklustre start to the European session, more so for Euro Stoxx 50 futures. Euro FTSE 100 futures actually in the green just slightly, but it's those Mercedes earnings looking likely to weigh on the DAX and therefore broadly in Europe. You've got the US 10-year Treasury yield at 4.17% currently, slipping for a second day as traders are repricing their bets on Fed cuts. But there's also this debate about ECB cuts as well. Is it really necessary to go for that 50 euro dollar at 108? The countdown to the opening trade starts right now.
It is Friday. We are counting down to the U.S. election. In the meantime, we have plenty of news to break, even on this Friday. It looks like the earnings story is coming in hot and heavy. That's where we'll start as we kind of digest what's happening in the bond market as well. And I'm going to throw it right to you because we're getting numbers out of Natwest.
Yeah, absolutely. Let's go to the banking sector here in the UK. Natwest third quarter pre-tax operating profit well above estimates. And in fact, looking across the statement, lots of numbers that have come in above where they were expected to be. And they do seem to be guiding higher as well, seeing their full year return on tangible equity. So this takes in the final quarter as well. They see that being above 15%. Previously, they'd said it would be above 14. Maybe not a huge upgrade, but it does seem to be something of an upgrade at the margins. Other targets they seem to be sticking to, so affirming the rest of their 2026 targets. So we'll see where this one takes us. Of course, we've had numbers already out from the likes of Lloyds and from Barclays. The focus on both of those, of course, of late. Certainly, we had numbers from Lloyds, sorry. The structural hedge very much in place for some of these UK banking businesses, and we'll get more on that later in the programme, of course, from our analysts. But that seems to be something that's decreasing the exposure that some of these banks have to declining interest rates.
Yeah, I mean, all in all, it looks like there's a lot of resilience among Brits, despite the interest rate story here in the UK. How much does that change as you see the budget coming next week on Wednesday?
Yeah, it's going to be interesting on how these trade as well, because that was one of the strong points, that point of resilience that we saw in the Barclays numbers as well. But I think the difference with Barclays, they have like other aspects of their business, the investment banking revenue they're trying to get in, the trading revenue as well. Does NatWest have that edge? I don't know.
Yeah, I mean, it's less of a sizable part of their business, isn't it? And to your point, Lizzie, we've seen UK consumer confidence coming out just overnight. That ticked down slightly. We saw the prior month was a really big drop, wasn't it? And that's when we were all talking about whether it was the talk of the difficult decisions ahead.
The doom and gloom.
The doom and gloom. And one of our reporters comparing it to the vibe session that we saw in the United States. Anyway, focus pre-budget on UK banks and the UK economy.
OK, so those are the NatWest earnings that we've just got. But we also, earlier this morning, got the Mercedes numbers well off their third quarter ambitions, not helped by the China economic slowdown. So a theme, of course, of this earnings season. But remember, they had already cut their 2024 sales outlook. Now they're saying they're going to have to step up cost cuts because of the car making margin dropping, because of this competition in China. Previously, they'd said that China should be like a blueprint for the rest of the world. Perhaps not so anymore. But speaking of that competition in Asia, we've also had Eni results. And a problem really for the European chemical industry is this competition in Asia. So for the oil and gas major, those results as well. Yesterday, confirming this €2 billion plan to reshape the chemicals business in Italy. So those ones to keep an eye on at the open too.
Yeah, absolutely. I mean, I was just drawn back to the Mercedes lines. I mean, the fact that the return on sales only 4.7% when their target, that the business's own target, is 8%. That's, you know, the extent to which they're undershooting their own expectations. And interesting that it's the luxury end that is struggling here, even though Tesla did OK. There's a lot of complexities to the earnings. We talked about that yesterday. But it does seem as if cost competition is going to be something of a defining factor for this part of the cycle, for these companies, because you've got the newer entrants who maybe have the advantage without a lot of the legacy costs that you see at some of the big German businesses.
And we were talking about from an economist in Brussels yesterday about this idea that the subsidies that the German government had pushed for a lot of these car makers have been rolled back. We're about 8 months away from a federal election in Germany as well, so the politics will matter for how Mercedes operates. Not to mention, will they fall below the footsteps of Volkswagen, who've also been having a lot of cost cuts and have actually shut down that major plant in Germany as well? Will Mercedes then have to face that same issue?
And we've got a big conversation later in the programme about the auto sector, haven't we? Ahead of the iPhone number coming out of Germany as well.
Yeah, it's going to be a fascinating one. And of course, as we talk about Germany, we've got to talk about the bond market as well. I keep being brought and reminded of the fact that we are very close to that federal election in Germany as well. But we have another election that's far, far closer, and that volatility is already showing up in the bond market as well. You can see that in terms of the 10-year yield. 4.17 is where we're at. A bid into the bond market this morning, down about 4 basis points. To me, this is interesting because we've seen this volatility, some of this around what that Fed pricing looks like, but so much of the Fed pricing, Anna and Lizzie, is really dependent on what we hear in just 2 short weeks.
Yields coming down then, it seems, just in the last day or so, in contrast to what we saw at the beginning of the week, which was all about that yield story rate on the rise. Europe, we saw yesterday a very clear pattern of yields coming down, expectations of more rate cuts from the ECB. But the UK, Lizzie, really stood out in yesterday's session, and that endured all the way through the session, the higher yield environment. Bit of nervousness around the budget, perhaps.
I was going to say, it draws back to what Kriti is saying, because actually it's more directly a fiscal story than a monetary story. Actually, it was kind of surprising to see these moves yesterday. Gilt's getting hammered when you've got Andrew Bailey talking about disinflation and previously hinting that you're going to get this more aggressive policy in future. But actually, it looks like what gilt traders were really responding to was Rachel Reeves confirming that they are going to change the fiscal rules.
Yes, and it's not entirely direct read across from the fiscal rules into what debt issuance you get, but that did seem to be a lot of the conversation yesterday that we were seeing in the Bloomberg stories and from those in the gilt markets was all about, well, what does this mean for issuance? When will she issue what? And that seems to be still a bit of a question, and of course we wait for the budget to find out the details.
But perhaps this is what she would prefer, to have the reaction now rather than on Wednesday, hence why she's doing all of this pitch rolling, not just at the IMF, but in the Guardian story and in the FT opinion piece as well. OK,
let's tell you what's coming up on the programme. We will have conversations with, firstly, Michael Metcalf, State Street head of macro strategy. Lots to discuss there about the US election. At the market open, we'll talk to Natasha Ebtehaj, Artemist fund manager, with a lot of views on US tech and some of the other things we've been dealing with, no doubt German autos in the mix as well. Later, we'll be getting a geopolitical view. We'll speak to the former UK ambassador to the United States, Sir Peter Westmacott, will be talking to us about the US elections. The first of a special series of interviews we'll be bringing you ahead of the US election on a host of market-relevant themes, this one focusing firstly on security in Europe. And UBS head of autos research, Patrick Hummel, will be with us to talk about Mercedes, amongst other things.
Yeah, Germany very much in focus this morning and in the next 24 hours as well. Let's watch out what else is going to hit that agenda item. German EFO data, of course, coming out about 9 a.m. UK time. You want to keep an eye out for that. Plus, those ECB inflation expectations. How much of that is really at the whim of some of the wage data that we get, not just out of Germany, but in the broader Eurozone as well? We're going to keep an eye on that. In the U.S., at about 8:30 a.m. New York time, we're going to get those durable goods orders as well. The manufacturing story remains a point of weakness. Luckily for the United States, it's only about 20% of the economy. Nevertheless, something to keep an eye on about just how much that pain gets worse. And then, of course, the central banks speak from around the world. We've got the Fed's Collins speaking. We've got Governor Villeroy over in the Bank of France as well. And then as well, the French finance minister, Armand, will be speaking as well. So we talk again about that fiscal story in the United States, in Germany. France has not escaped that just yet.
I'm reminded when we talk durable goods, yesterday we were talking Boeing. That's sometimes a feature of that data print, isn't it? And, you know, if they're not producing quite so many aircraft, so maybe we'll have a bit more detail on that. Germany very much in focus then. We've mentioned the IFO data. That's out at 9 UK time, isn't it? A little bit later on this morning. Last month, we sort of added to evidence of recession in Germany. So once again, we're looking for more on that. But just the sort of bigger picture, I suppose, the levels that we're seeing on the IFO, so these confidence levels, they are not at 2022 levels. So we're not talking about as depressed as we were at the height of the initial invasion by Russia into Ukraine. But it's still very depressed versus pre-COVID levels, versus 2021, beleaguered. the economy.
I think it'll be really fascinating to hear what Clemens Plus and the rest of the committee really has to say as well, because he has previously made in those comments on the data itself, but in the comments, that a lot of the sentiment around Germany is relevant to the elections around the world. And he's really commented specifically about that defense policy. I'm going to put my guy Jonathan on. As we get that 9 a.m. data, I'm going to be deep into those comments to figure out this close to the U.S. election just how bad the jitters actually are.
All right, so we'll keep an eye on that EFO data when it comes out at 9 a.m. But let's get to what else you need to know this morning. After a delay, a team of NASA astronauts are making their journey back home on the SpaceX Dragon capsule after completing a 7-month-long expedition. The astronauts were first scheduled to return on October the 7th, but were delayed by Hurricane Milton in Florida. We're going to bring you live coverage of the splashdown, which is expected at 8:30 a.m. UK time. Elsewhere, Bloomberg has learned that Allianz is considering options for its global investors unit as the German insurer seeks to grow its asset management business. According to sources, the early stage considerations may include tie-ups and partnerships, but Allianz doesn't currently plan for a full or majority sale. And shares of fashion group Capri fell by nearly half in US late trading after a federal judge blocked its proposed takeover of rival Tapestry. The judge ruled that the $8.5 billion deal would harm competition for, quote, accessible luxury handbags. Tapestry, which owns Coach, of course, rose 14% post-market after the announcement. Well, that is a hell of a win for the FTC in this mission to kind of could protect the consumer, stop takeovers that undermine competition. I'm thinking I had to look into all the very many handbags that are owned by the... I just had to.
Research for the show.
But, you know, Capri, Michael Kors, Versace, Jimmy Choo, Tapestry, Coach, Stuart Weitzman and Kate Spade. I think there's quite a difference between those two.
There is quite a difference, but this is a story that's been in the making, I want to say, for a decade now, where Michael Kors really began this whole venture with Capri Holdings, really taking on Jimmy Choo, Versace, et cetera, and kind of injecting it with liquidity. The vision, the initial vision, was to have a U.S. kind of equivalent to LVMH, some sort of actual competitor where you have this overarching brand that can do it. The problem is that the Michael Kors strategy, I'm nerding out a bit, stick with me here. The Michael Kors strategy for a lot of luxury is very different than in this side of the ocean, which is make it available to the masses, which is kind of mass consumption, the very opposite of perhaps the strategy that Bernard Arnault uses here. But in that view, to create this kind of massive arm or umbrella of all these luxury names is, of course, caught in the ire of the regulators.
Well, which is interesting because you've seen Burberry taking the CEO from Michael Kors, Joshua Schulman. So do we actually start to see a bit of that accessible luxury coming across the pond?
When we saw that ruling from the FTC and the wording of it around quality handbags, affordable prices, I was thinking, but what role does competition play in pricing in this sector? Because I'm so influenced by the European story where it doesn't really seem to be anyone competes on price. They compete to be more expensive. That seems to be how things go. But, I mean, I like to draw attention to the fact that it's not just because Guy is not here that we're talking about handbags. Hedge funds are watching this closely, hence one of the reasons why we saw such a big, sizable move in some of these share prices after hours.
Yeah, it's really fascinating. When the idea is, you're right, it's not a pricing story as much as it is, this does not exist in the United States, this kind of luxury overhang, because so much of it is competing with European companies who also have their hands in several kind of American consumer bases as well. This is a fascinating one for me to see whether this experiment would even work, because the initial, like I said, plan was really to kind of inject the likes of Versace and others with that kind of liquidity that they couldn't get.
Coming up on the programme, we are going to, as I mentioned, kick off our special coverage in the run-up to the US elections. Today, the focus will be on security. Plus, Olaf Scholz meets with Narendra Modi later in this programme. We will have the latest from Delhi about what is being discussed, what that relationship looks like. Up next, the Bundesbank President echoes Christine Lagarde's data dependence mantra. We'll talk rates and markets next. If you have any questions, please get in touch with us. If you want to be part of the programme, you can use the function IB plus BBTV Go. We're live from London. You can't see much of London this morning in that shot, but I promise that's where we are. This is Bloomberg.
Too hasty. We should be cautious, keep our track to really look what data is coming in. We have in December when our next meeting is coming. We have our new projection. The new projection will include the year 2027. And then we have maybe more guidance, more orientation. But I'm not in favor to speculate too much what is necessary in our December meeting. This is definitely, I believe, not helpful.
That was the Bundesbank President Joachim Nagel there speaking to Bloomberg from the IMF annual meetings taking place in Washington. For more on the ECB's rate path, let's bring in Bloomberg's Valerie Teitel, who can give us the latest thinking in the markets. We saw this evolving quite a bit yesterday. Europe's central bank then is still debating a half-point cut, it would seem. What does the market think?
Yeah, and Nagel said he doesn't like to speculate, but the markets, Anna, they love to speculate. We're now pricing in 70 basis points worth of cuts for the next 2 ECB meetings. So the market really does think that in one of those 2 meetings, either in December or in January, we are going to see a supersized 50 basis point cut. But we have heard a lot from ECB members talking at the IMF. We heard from Peter Wunsch yesterday. He also threw a bit of cold water on this speculation.
I don't see why we should today have a discussion on a 50 basis point cut in December. I think really it's premature.
Maybe it is a bit premature, but we have seen the euro slide because of these expectations for further cuts from the ECB and because of the dollar strength behind the U.S. election. It's now weakened nearly 3% since the start of this month. But I want to look at what's going on in the options market because I found this chart very exciting when I came across it this morning. Now, let me take you through it. This is the rise in 2-week option volatility. So now that we are within the window of the U.S. election potentially being called, we saw a very large rise in this 2-week option volatility. It features as one of the largest 25 ever seen since the euro launched and one of the eighth largest since the European debt crisis. It really goes to show just how nervous the market is about these potential tariffs that a Trump win could entail. We also heard from Goldman. They say there is a potential decline of 10% in euro dollar if we do get a Trump win and he does follow through with those strong tariffs.
Valerie, thank you. Bloomberg's Valerie Teitel taking us down memory lane there with a few reminders of periods of volatility we have known and loved. Let's talk to Michael Metcalf, Head of Macro Strategy at State Street Global Markets. Michael, very nice to have you with us. Let's get your view then. Euro-dollar there, the focus of a sort of transatlantic divide that conversation you can take in many directions. But it seems as if the market very much focused, even away from the politics, focused on what the near-term rates outlook looks like and the possibility that the ECB cuts more deeply, more quickly, more in general. What are your expectations for sort of euro-dollar and how we see that tension expressed there?
Well, I mean, first off, from the ECB point of view, I think the ECB have done a very good job in guiding expectations, even just from the start of the rate cutting cycle to today. They are now clearly trying to just rein the market back a little bit, but the direction of travel is very clear. I don't think it's just about getting rates to neutral in Europe. It'll be getting rates to below neutral. Let's see how bad the IPO is this morning, but I think it's quite clear that the European economy needs more than just neutral rates. It needs easier policy. OK, and how does that leave Europe if the Fed is not cutting as aggressively? And there are various scenarios based on who ends up in the White House. But if the Fed isn't cutting that aggressively, but Europe is really cutting a lot, what kind of tension does that throw up? Yeah, but I think the interesting thing is that investors have been positioned for this for quite some time. So, investors have been really quite bearish on the euro. Even actually when we've had periods of appreciation this year, one of the things we observe is that asset managers have been underweight the euro all year and remain so quite significantly. So I think they are prepared for it, but definitely relative rates are going to be favourable for the dollar relative to the euro, regardless of who's in the White House.
When we're talking about that euro-dollar exposure, though, how much of it is what's happening in the States versus how much of it is happening in terms of the budget and the fiscal budgets that you're seeing in Europe? It feels like it was a bigger deal over the summer, and now it's kind of been brushed off. Yeah, I think right now, certainly in Europe, relative monetary policy is what's in the driving seat. I think there's also another interesting story that's bubbling along about fiscal sustainability. And it's difficult to tell whether that is just simply because we've just had the IMF's fiscal outlook, and obviously we have the election and the UK budget coming up. But I think right now it's still, the ECB is still in the driving seat. But I would keep a very close eye on whether, and just the fact that we're talking about fiscal sustainability is a thing. And that could, of course, come back to bite Europe later. It is a thing, but it's not being priced in. And it's also not being priced in the States either, where you have a looming deficit and it's supposed to hit the long end of the curve. You're not seeing that reaction to the same extent you saw, say, literally a year ago today.
Yeah.
Talk to us a little bit about how you play it. How do you trade it? How do you hedge it come January?
Well, the fiscal sustainability theme is very episodic. And it's not too dissimilar to the volatility chart that Valerie just put up, actually, is that there'll be periods where the market will fixate on it and the financial media will fixate on it. And you have to be very wary. You know, we know the countries that are vulnerable in this environment. And you know, as you say, I don't think investors are prepared for fiscal sustainability to become a more sustainable theme just yet. So, you know, I think it's difficult to hedge it because actually debt levels are high everywhere. And you have to wonder whether the US ends up as the safe haven yet again, simply because they're a reserve currency.
But where you have seen traders reacting to the fiscal situation is in the UK. Yesterday, gilts getting hammered. Do you think that's the worst we're going to see in terms of market reaction as Rachel Reeves is rolling the pitch? Is she getting it out of the way now before Wednesday?
It looks a lot like that, doesn't it? And I think that there's been this question about how the Labour government would create fiscal headroom. And, you know, I think so are we calling it the snuffle, the shift to the public sector financial liabilities? That has been well flagged before, you know, as has the change with the Bank of England accounting. So I think, you know, it was just getting that out ahead of the actual budget, which I think is quite sensible. And, you know, the one interesting thing we'd observe right now in terms of investor behaviour is that investors have been somewhat hesitant on long-dated treasuries, for instance. So the selling we saw in those in October was the largest we'd seen since the pandemic. But here's the interesting thing. Investors were still buying gilts. So you know, the long-term investors who hopefully will look through bumps like yesterday were actually, you know, their sentiment was quite favourable towards gilts. So that would, for me, would suggest that yesterday would be the worst of it.
I mean, it was kind of confusing when you also have Andrew Bailey talking about aggressive policy when it comes to monetary, but not actually reiterating that line this week. Have you taken that as him kind of rowing back on his previous statement to The Guardian?
Well, so here's the interesting thing. So while the ECB, I think, has done a very good job in managing expectations and in general reducing interest rate market volatility, I think the Bank of England has been a lot harder to read. And there's been this kind of long-term tension, really, that we've seen for much of this year, which is that the economy looks quite soft, and yet rate markets haven't priced that much in, and that's because of the Bank of England's communication. And I feel like they've been waiting you know, to get through the budget. Let's see how expansionary it really is. And then after that, then you know, maybe we can get pricing that will look much more like the economic weakness that we see in the UK economy.
Michael, can I take you back to the US election just briefly, bringing this conversation to a close as we're so close to it now? We focus on what's happening in financial markets, of course, and we focus on the polling. Looks razor, you know, there's nothing between them in some of those swing states. And then there's a lot of mention of betting markets. Some taking that very seriously, what we see in betting markets. Others saying that's not actually that much of a good signal. What do you respond to? What do you look at?
Well, so we actually look at relative media sentiment, both at a national level and you know, go right down into the swing states. And that really, it does suggest that Harris has lost a bit of momentum, but actually the media sentiment in somewhere like Pennsylvania, for instance, is still actually slightly pro-Harris. And so what seems to be happening is that the betting markets are, you know, suggesting it's much more likely that we get a Trump and a Republican victory, but that isn't filtering back through into the media.
Okay.
And so I think that's important. I think it might suggest that the betting markets are overly confident.
Okay, really interesting. Thank you so much. Thank you for joining us, Michael Metcalf, Head of Macro Strategy at State Street Global Markets. Coming up, we'll continue that focus on the US election. With that US election looming, the head of the IMF speaks to Bloomberg and says the world's biggest economy is in good shape. We'll have that interview coming up for you next here on this programme, 7:26 here in London. This is Bloomberg.
30 minutes from the start of the opening trade. Look, a lot for DeMarcus to digest here. You've got some earnings stories, you've got some of the bond market volatility, but at the end of the day, it is Friday. We'll see how much de-risking happens into the weekend. In the meantime, we're also talking about what's going on at the IMF and the World Bank meetings over in D.C. This year's annual meeting yielded Managing Director Geeta Gopinath speaking with Bloomberg's Lisa Abramowitz about inflation, tariffs, and the prospects for the U.S. economy.
Very important. What happens in the U.S. matters for the U.S. and matters for the whole world. So as you can imagine, it is an important part of the conversation.
Is it making people feel paralyzed? And I'm talking about policymakers and I'm talking about, investors. Is it making people feel like they can't really make any moves until there are some outcomes for some of the big events and the elections that are coming down the pike?
When you see the data, you don't really get that impression that people are paralyzed. If you look at the U.S. economy and how it's doing, consumption is doing very well. Labor markets are doing well, even though they've slowed some. And the financial markets are very strong. Financial conditions are easy. So you aren't seeing any, negative knocks coming from that uncertainty right now. But yes, I think as we get closer to it, that goes up. And we'll see what comes after that.
Yeah, and I was speaking with the Bundesbank president this morning, and he was talking about how it's hard for him to really gauge some of the inflation risks, because for them, inflation would be a lot higher. Do you feel like that's the case, that interest rates are going to have to go up more significantly as more tariffs go into place?
What we do know is that tariffs are inflationary. They do put pressure on prices. That's usually what we see in the data, looking at past episodes of tariffs that have been put in place, right? In addition, there is a very important question of what the stance of fiscal policy is going to be around the world and how expansionary it's going to be. The U.S. economy is very strong right now. At the same time, we are seeing inflation coming down, and our expectation is that it will continue to do so, and the Fed will continue to cut rates. Now, if there is a much more expansionary fiscal stance, that could move the argument in a different direction.
Are you surprised that interest rates, I don't want to say interest rates, that 10-year Treasury yields, that the benchmark Treasury yields on the longer term, or even just globally, aren't reflecting more the $100 trillion of global debt that you've reflected in your latest IMF projection?
The rate is going for the U.S. debt is going to also be a function of the strength of the U.S. economy, the strength of its institutions, and there's tremendous faith in that. Again, the U.S. economy is one of the strongest among the major economies, if you look at those. And when we compare the U.S. to the other G20 economies, it's the only economy whose GDP is higher now than we had projected before the pandemic. The only major economy. So it's a very strong economy, a lot of confidence in it, and that's showing up in the yield numbers too.
So that was the IMF First Deputy Managing Director, Geeta Gopinath there. I mean, like many economists saying that tariffs are inflationary, but I thought what was interesting in our interview with Donald Trump with our Editor-in-Chief, John Micklethwaite, was actually how enthused the audience was by his own enthusiasm for the word tariff. This is an audience of, Midwest business people, and they were lapping it up. We have to think, though, about the flip side of that, especially for Europe, Kriti, of Donald Trump's potential tariffs.
Yeah, it's a fascinating one because the idea of tariffs and the way it's been framed domestically is not through an inflationary lens, which is, I think, what we're used to hearing from the economists, that it is indeed inflationary and that's going to hit the cost of living and the affordability story. But domestically, it's a question of bringing jobs back to America. It's a question of kind of owning a lot of the industries that some would argue in the last 20 or 30 years have been outsourced to other countries. Technology, chip manufacturing, even autos, for example, is a key piece of that political rhetoric. And I think that's where you're seeing the tariff story really take place and are most relevant to Europe, especially in the auto space.
Yes, and we certainly heard Donald Trump making that point, that that's what he wants to use the tariffs for, to try and bring manufacturing back. I mean, it's interesting to see that many talk about the IRA under the Biden administration as having similar aims and maybe having some successes in that space. Meanwhile, less than 2 weeks to go until the election, Kriti, and we see both sides, to some extent both sides, wheeling out celebrities of various types, various genres, to try and tap into support from parts of the audience that they just feel like maybe they're not reaching as they should be.
I mean, the strategy is fascinating here. The fact that Kamala Harris, taking over from Joe Biden, who's really criticized for his age and his mental faculties as a result of it, is really leaning into that Gen Z demographic, that younger demographic, doing more social media, doing more podcasts rather than traditional network interviews or even traditional debates that you've seen in previous elections. Right now, both, I believe in today, you were seeing both Donald Trump and Kamala Harris campaigning in Texas, a traditionally red state, 40 electoral votes. So this is a very big one in terms of what could move the economy. It's a red state. It's usually harped in a lot of kind of oil money, et cetera, that you're going to see in there. Yet Kamala Harris is campaigning there, and a lot of that has to do with border policy. Remember, immigration is a key piece of this election. It is the #2 voting issue right after the economy and affordability as well. And to top it all off, to really maybe have an access point, Texas, that is a traditionally red state, she's enlisted the help of Beyonce, finally getting the clearance for the Freedom song that she's been playing on her campaign trail. Kind of an endorsement from Beyonce, sort of, in getting that permission, but it brings back, it's sad that Guy Johnson isn't here, some memories from about a couple months ago when Taylor Swift gave her ringing endorsement.
You do need to get that permission. I remember in UK politics, there's been a few times where political parties have used songs without getting permission, and they've just been met by a huge backlash from the band in question, saying, hang on a second, we didn't endorse this.
I have to say, maybe it shows that I'm not Gen Z and I'm actually a millennial, that I was more impressed by Eminem opening to Barack Obama and then Obama rapping.
Yeah.
You know?
I mean, on the charm offensive off of Eminem, it was fast. I loved that rally. It was so fascinating. But you could see what they're trying to do here. They're trying to be more in touch with the people, that this is not a kind of divide between politics and generations. This is somewhere where we're accessible. We follow the same music you do. We'll see whether or not that yields results. It's certainly something that's going to be a topic of conversation as we see these next 2 weeks ahead of the election, among other conversations like tariffs, immigration, defense as well. We have the perfect voice for that later. We're going to be joined by Sir Peter Westmacott, the former British ambassador to the United States, but France and Turkey as well. It's going to be a fascinating one in terms of what that defense policy actually looks like. We're going to discuss what's at stake for Europe's security and defense with the United States election just around the corner, something that's arguably already being priced in some of the defense stocks, even Ukrainian bonds.
Right, yeah, absolutely. Watching all of that. An increasingly unstable geopolitical landscape then as we approach the US election. It's been upending the post-Cold War dynamic, with US-China rivalry helping remake global trade. But as some nations choose sides, there are a few who are taking advantage of the situation. Bloomberg Originals has more on the so-called new neutrals.
The aftermath of the Cold War meant a boon for multinational business. But pandemic lockdowns and modern conflicts are perhaps ushering in a new era.
Globalization isn't ending, but globalization is changing shape.
In the midst of this, some countries and companies are finding it best to hedge their bets.
There's a much bigger family of economies who have chosen not to take sides in this big geopolitical realignment.
Since the Ukraine invasion, countries that voted yes in the UN to support Ukraine have fallen into a US-led pro-Western bloc, while countries that voted no, abstained, or didn't vote at all fell into the pro-Russian bloc. At least 101 countries have always abstained or fell into neither bloc. These are the new neutrals, countries like India, Malaysia, Nigeria, and Brazil.
Where greenfield FDI goes, jobs typically follow. It's one of the best indicators to gauge sentiment among the world's biggest companies.
Greenfield foreign direct investment measures money going into new operations in foreign countries. Jockeying for foreign investment before 2020 remained fairly even-handed. Then look at what happens with COVID and the invasion of Ukraine. Pro-Western investment jumps, pro-Russia investment falls, and new neutrals soar.
That's just an introduction there. There's a lot more. You can watch the full documentary on the terminal and on Bloomberg.com. That from Bloomberg Originals. It is 7:39 here in London. Let's stick with the geopolitical theme and take our conversation global. German Chancellor Olaf Scholz has arrived in New Delhi as his delegation looks to strengthen trade ties with India. Scholz's team will be on the lookout not only for new markets for German companies, but also for skilled workers to boost Europe's biggest economy. Concerns over China's growing influence will also be on the agenda. We're now joined by our India correspondent, our India government reporter, Sudai Ranjan Sen. Very good to speak to you. What are the key areas in which we're likely to see movement then between the two countries?
Well, I mean, the big movement that we're going to see is the, announcement of intent to work much more closer. Mind you, German Chancellor is here with 8 of his ministers of his entire cabinet of 16, showing the intent of how Germany is trying to build a strong relationship with India. Similarly, India is also looking out to build a much more stronger relationship and looking for technology to ramp up manufacturing in the country and therefore jobs for millions of Indians. The movements that we are likely to see, big announcements, are likely in the sector of mobility, in the sector of transition, green transition, and also defense. These are the three core areas that we understand are going to really move with the intergovernmental consultations that are likely to take place shortly from now.
Talk to us why this is now coming into kind of focus now, especially when Germany and India don't really have that trade dynamic in the first place. If you look at on the Bloomberg terminal, the top 15 trade partners on either side Germany doesn't come up in the first 15 for India and vice versa. Why now?
Well, I mean, lots of things have changed. I mean, one of the things that have really changed the way Germany looks at the world, did policy earlier and is trying to do right now, is the Russia and Ukraine war. That's been a big wake-up call. At the other end, you have Prime Minister Modi on his third term really pushing very hard to base manufacturing here, and which would mean getting access to critical technology, get India into the supply chain of the world. Now, this is very, very important politically for Prime Minister Modi, because India has a huge youth bulge and you need jobs for that. And that is exactly what Prime Minister Modi is trying to cater. So in a way, it is a win-win for both. On the other hand, if you look at Germany, one of the biggest economies, is looking out for trained, skilled workers to help it out as its society ages. So again, there is a win-win in this too as well.
I mean, does it make political sense, geopolitical sense for Olaf Scholz to be embracing Modi when he's fresh off the trip to the BRICS summit in Russia, where he hugged Vladimir Putin and he just signed this border deal with China?
Well, I mean, every country, if you look at it, even Europe, has been or has dealings with China, and this is in fact one of the questions that came up in the press briefing yesterday with the German Vice Chancellor, and the answer that reporters got was, India's point was, while you deal with China, which is India, with who India is very, very tense and a tense relationship right now, although things look to be on the mend. Similarly, India has a relationship with Russia, and that relationship is not new. That relationship is very old and goes, at least 7 decades.
All right, Bloomberg's Sudhi Ranjansen, we thank you so much for giving us that crucial context. Of course, as we are waiting, live pictures of New Delhi, where German Chancellor Olaf Scholz will be meeting Prime Minister Narendra Modi. You can see that location here. Again, they are preparing for that state visit. As we get more information about what that conversation actually looks like, we will certainly keep an eye on it. It's a fascinating one as well, just given that at the time we are not actually seeing that trade relationship develop, but very much could. Germany really putting itself at exposure for some criticism from some of its Western allies, given that India is dealing with Russia in a way that other economies are not, something we're certainly going to be monitoring throughout the rest of the morning and the day. Coming up on the program, however, switching gears a little bit to the banking sector, Natwest improving its guidance as it reports third quarter profit ahead of expectations. More on that next, and your other stocks to watch at the opening trade. Stick with us. This is Bloomberg.
Welcome back, 7:47 here in London. The futures picture looks a little mixed. Overall, weaker, actually, 0.3% weaker for European stocks. That's the expectation at the start of trade. And in terms of the US futures picture, that looks pretty flat. So perhaps a little calmer in these markets as we see Treasury yields change direction towards the end of the week after that big ramp up in yields we saw at the start of this week. What are we talking about in markets? Let's get the thoughts now of our Markets Live executive editor, Mark Cudmore, who joins us for the markets in 3 minutes. Mark, let me ask you about what's going on in Japan then. Ahead of the election, we do seem to see some softness coming through in the Japanese equity market story. Dollar yen pretty flat, although weakness in the currency has been a theme of late.
Yeah, very much so. I think my team are very excited by this election on the idea that if we do get the LDP results, then therefore BOJ hiking might be moved forward. I'm not convinced the election will have as big of an impact on monetary policy as people think. I think that the way investors are looking at this, it suggests the kind of underlying positioning bias out there, that much of the market has been wrong-sided by the yen weakness the last couple of weeks. And therefore, these are yen bulls who are getting desperate and saying, hey, maybe the election can be back on our side, can re-stimulate yen strength. And that's the kind of theory that is again also weighing on stock markets, that the election might prompt hikes to be more aggressively priced after the weekend. I'm worried that may not be the case, and so therefore the more likely outcome is that we again see yen weakness extend next week.
Talk to us a little bit more about the currency picture, especially when it comes to euro dollar. Goldman talking about a potential 10% decline if we do see a Trump 2.0. Is that a valid one?
I mean, it seems very dramatic to me. I have to say, I am structurally bearish the European currency, but very much on a long-term basis. You've got to remember this is a currency that's very stable overall. It's got very low volatility. Sure, European growth's not looking good. There's not a great amount of political leadership across the continent at the moment. It's not looking very, very promising. The more volatile component, though, of euro-dollar is the dollar side of the trade. I actually think that the post-election, if Trump wins, that will be probably maybe the peak of the dollar rally. I think that, you know, it's not in a binary moment, the election. People are pricing in an increasing chance of Trump winning the election via the currency markets as we get closer. And I think it's in currency markets where we're seeing that pricing most clearly. So I think we'll see an extension if Trump does indeed win. But I think then that the negative side of a potential Trump presidency start to weigh in the dollar. So I think if Trump does win the election, that'll be the final stages of the dollar rally.
And Mark, Anna mentioned about Treasury yields slipping for a second day towards the back end of the week here. Is there a point at which the stock market really reacts to this bond market story?
No, not really. Not anytime soon. Ultimately, yields have lots higher to climb, and that's because the US economy is absolutely doing wonderfully. Of course, we get to a point where high yields constrict the economy, they constrict the consumer, and ultimately that causes problems for the economy and hence the stock market. But I don't think we're close to that point, and I don't think it's about a level. It is about enough pressure on the economy over time, and I don't think we're close to that. So I think the yields have much more to rise, particularly at the back end of the curve, though, because of those fiscal concerns.
All right, our Bloomberg Markets Live Executive Editor Mark Cudmore. Remember, you can get up-to-date analysis and insight from Mark and the team by going to MLive on your terminal. Well, let's look ahead to the Open now. It looks like the European Open is going to be dominated, at least for the DAX, by these Mercedes earnings. The DAX futures pointing lower 0.2% currently, and we can go under the hood now with Oliver Crook. Mercedes saying it plans to cut costs after fierce competition and weaker demand in China, hitting the luxury car makers' profit margins. Oliver Crook joining us from Germany. Break down those numbers for us, would you?
Yeah, so listen, Lizzie, they pre-released their earnings, and they said a little earlier on that they're going to have a profit warning, and they said that their volumes were down overall 3%, right? So volumes down 3% isn't great year on year, but it's not the end of the world. What we got today, and this is absolutely critical, is their margins. Their margins last year were above 12%. The estimate for this quarter was 8%. What we got was 4.7%. That is exceedingly poor for Mercedes-Benz, a car maker that has basically abandoned the volume game, saying that we don't want to sell the most number of cars, but we want to sell very high-margin cars. It is particularly interesting, Lizzie, when you look at what we got from Tesla this week, and when you look at the comps between these two car makers, where you had the margin at Mercedes, as we said, 4.7%, Tesla 17%. When you look at their actual volumes, Tesla is catching up to Mercedes-Benz. Tesla sold 460,000 cars. Mercedes only sold 500,000. And when you take the cumulative move on Tesla yesterday, that was $153 billion worth of market cap. That is bigger than Stellantis, Volkswagen, BMW combined, which just gives you a sort of impression of how investors are facing Tesla versus the European car makers.
Certainly something we're going to be keeping a very close eye on. Bloomberg's Oliver Crook, we thank you so much. Let's get to our other stocks to watch this morning. Joe Easton standing by from our equities team. Joe.
Morning, Kriti. So Natwest is beating expectations on their net interest income today, saying they continue to see growth across their loan book. Their loan loss provisions, though, actually slightly higher than analysts were expecting, but it does look like the net interest income will be the main focus. That stock actually up 65% already this year, and 14 buys, not a single sell, so potentially priced to perfection. Therefore, we'll have to wait to see how those numbers are digested. Then over in healthcare, we've got numbers out of Sanofi, the massive French firm. They've upgraded some of their guidance on some of their vaccines and also beat expectations on the third quarter. That stock has actually bounced around a bit over the past couple of years, given some litigation concerns and worries about R&D spending, but has actually recovered and trades at a pretty high level at the moment. Then over in defence, we've got Safran, another big French company. Now, this firm actually downgrading some of their profit guidance today, but a lot of that seems to be due to the French tax measures that are going to come in. The orders still look really strong, and that stock, of course, has rallied. It's doubled in value over the past couple of years, given the two wars that we've seen going on. And also, the orders still looking pretty strong. So in terms of a read across, it's probably actually going to be more of a positive for companies like Rheinmetall, Saab, Leonardo and BAE. But in terms of Safran itself, those worries about French taxes are looking to be a bit of a negative for the stock this morning.
Thank you very much, Joe Easton, with the latest on those stocks that we are watching. The context yesterday, we saw quite a surge in travel and leisure stocks. They really stood out to the upside, but elsewhere we were kind of range-bound on these European equity markets. And looking at the US futures picture, we look pretty range-bound there as well.
We absolutely do, and I think everyone has really actually continued to make this point that you are starting to see the stock market that's very volatile, but the bond market could have those ripple effects as well. More volatility in the bond market yesterday than in the stock market. We're looking at 418 on the 10-year yield. Of course, at 8 o'clock, we get the opening trades across Europe in the stock market, but also the bond market. Stick with us. This is Bloomberg.
Welcome back. Friday morning. A few minutes to go until the start of trading here in Europe for this Friday morning. Welcome back to the opening trade. Now, it's an interesting setup we have going into the European session today because, in a sense, we look as if we could be positioned for a rebound. But I know, Kriti, that that's not what the features tell us. But this is the European session yesterday in the white. And then the US session actually rebounded after we closed up. So there is a sense that we could go higher on that. But if some of that sentiment, that positivity, was being driven by Tesla and the US automaker story, or specifically the Tesla story, then there's maybe a limited sense to which that translates into European autos, especially given what we've heard from Mercedes today. So I think the futures picture doesn't necessarily then, Kriti, reflect what we're seeing here in the US session yesterday.
I think it's a key point because you're starting to not see that outperformance, or the underperformance, I should say, in Germany. In fact, you're actually seeing it really concentrated in France here, only down by 0.2%. But look at what is actually vaguely, marginally in the green, Lizzie. Is the FTSE 100 flat on the session right now? Do we start to see more volatility, or is this simply an image of de-risking ahead of the weekend on that traditionally Friday vibe?
Yeah, green on the screen for the FTSE 100 futures, but the DAX futures down 0.2% because, as Anna mentioned, we've had those Mercedes earnings well off their Q3 ambitions, not helped by the China economic slowdown. But we'll also keep an eye on Natwest, beating expectations on net interest income, improving guidance for the year. And we must watch Sanofi as well, known, of course, for being the owner of France's best-selling painkiller. They reported higher profit on demand for flu vaccines. So all of these stocks to keep a watch on at the open, Anna.
Yeah, a few stocks then with numbers out, and they could move on that. The broader dynamic then, it does feel as if we're bringing the week to a close. We're a little quieter in terms of those earnings stories than we were earlier on this week. Lots more of that next week, though, still to come. For the moment, eyes on Friday. Let's have a look at where we go on these European equity markets at the start of trade. As we've just been talking about, Kriti, expectation then that perhaps we see some weakness in the German market as a result of that number out of Mercedes, by which I mean the return on sales number, which did seem to come in pretty weak, lower than the expectations or the targets that the market has and the business has for itself. The FTSE 100 looking pretty flat, looking to see if we get any movement in NatWest on the back of that beat on a host of numbers coming through from the UK bank. But broadly, things looking pretty flat. We had a bit of in terms of the global equity market story, we have seen higher yields, of course, at the start of the week, and that was making some markets a little nervous. And we saw the US equities, for example, selling off in the middle of the week. We're not seeing the DAX trade yet, so we will still wait for that. Kriti, what do you see under the hood?
We're seeing pieces of the DAX trade, I think is the way to maybe phrase it. And we are, of course, keeping I'm going to say this right. Our eyes out for Mercedes. This isn't going to be an interesting one in terms of whether or not we do actually see the rest of the markets take its cue from Mercedes, some of the other automaker stocks right now. But when you look at the downside performers, Anna, it kind of feels like a lot of this is isolated in some of the sensational six that are not so sensational this morning. The idea here that Novo Nordisk is going to be your biggest index weight right now. A little bit of a mixed picture when you look at the sector perspective. Technology and banks seem to be your outperformers. I'm not sure if we can read anything from the sector breakdown.
Yeah, I'm not sure it's telling us a huge deal. Sorry, Lizzie. Yeah, Basic Resources doing okay.
Yeah, Natwest, the best of the banks, higher 2.6%. So, as I say, off the back of those results, leaning more on the net interest income aspect of their earnings than the loan loss provisions, which were actually higher, slightly higher than expectations. But you've also had improving guidance for the year. So, therefore, hence why banks are the second best performing sector on the Stoxx 600 this morning, higher 0.25%.
Interesting. Yesterday, we saw some weakness coming through from the French market in the shape of Michelin. We talked about that a little bit. The tyre maker was under pressure. Today, we see Vinci, the construction business in France, under a little bit of pressure, not by quite so much, but down by 2.9%. So that adding some weakness to what we're seeing in the French market, which is down 0.1%, underperforms the rest of Europe just a little. But it seems that their revenues at Vinci missed estimates. But analysts saying that the momentum there is generally intact. But that adding up to a 3.2% move to the downside.
Yeah, it's going to be interesting when we see, again, we're waiting for Mercedes to open. We're waiting for Merck to open as well to see how the DAX trade. We'll probably give it another couple of minutes to see how that all shakes out. I think it is crucial, though, that you are seeing pain in Safran as well. This perhaps is a little bit of a hangover from the Boeing story that we got in the last 48 hours as well. Just given that's in the supply chain, that's going to be something we keep an eye on. Sanofi, on the other hand, rallying higher by 2%. It's your biggest volume, I think, mover to the upside as well. Now we've got Mercedes, a quote on Mercedes, down about 3%. Again, those cost-cutting measures, yes, they may be trying to be more profitable. Yes, that might be a good thing. But right now, investors really zeroing in on just how much pain there actually is. And that's going to be something we're going to be looking to previous elements or previous moments in history of whether or not they can actually survive that. Let's take a little bit of a zoom out, if we can, though, and talk a little bit about how we go forward from some of the bigger heavyweights around the world. Aquamarine founder and CEO Guy Spire spoke to Bloomberg earlier today.
You know, this is a very, very long-term game. So the Nifty 50 in the 70s, you know, they fell apart. And it looks like the Magnificent Seven aren't going to fall apart anytime soon. And by the way, about 2 years ago, in frustration, I ended up buying some Google. So I'm a little bit participated in the Magnificent Seven. But the world is big and the game is long. So don't worry about me.
The world is big and the game is long. Let's bring in another voice here who I'm sure agrees with that statement. Natasha Ettehad, founder manager over at Artemis Investment Management, joins us around the table. All right, so the world is big. We have plenty of time, apparently, on our hands. How do you then trade going into the end of the year? What is the trade you think is the one to do?
Well, going into the end of the year, we've seen a trend that markets are starting to broaden somewhat. A lot of this year, the trade has been very much focused on the AI supply chain. Well, our supply checks indicate that actually probably is a trade that will continue into 2025. But other things are now coming into focus. So we're starting to see the foundations of a global policy pivot, not just the the global policy put. So not just the US cutting, Europe cutting, lots of central banks, now China coming into play. And essentially we feel that policy put is going to flow more into the fundamentals of more sectors and more companies helping earnings lift. And so we're trying to broaden out some of the sectors where we're hunting. So US house builders is somewhere that's been interesting. We've been adding there in recent weeks. Rates coming down, less uncertainty post-election, and a structural underbuild there is an interesting sector. China, it's now back from the uninvestable dead. That's somewhere we've also been adding. And so those are areas which we think could continue to do well into 2025. And there's new areas as well, like potentially the consumer. We're maybe starting to see a turnaround in some of those staple stocks where volumes have been under pressure after years of too much pricing. Looking for opportunities in areas like that.
When we talk, I'm going to zero in on the home builders piece as well, because so much of that sector is dependent on actually the bond market, which has been a major theme here, and that you look at the long end of the curve. But the long end of the curve is also extremely vulnerable to what's going on with the U.S. deficit as well. Why are you so confident on that home builder trade when it could be quite vulnerable just in 3 short months.
Yes, no, I mean, rates and equity markets is not really a perfect tango. I mean, we're looking more at interest rate expectations. Here we've actually seen probably interest rate expectations fall now for the majority of this year so far. I mean, it's been very up and down, but the general direction has been down. We are ticking up again, maybe on where we think the rate cuts are coming from. But in general, that rates, we do expect that trajectory to continue to trend downwards. And the fundamentals of these companies are still strong. And we expect that to pick up into next year.
Can I ask a bit more about China? What convinces you then about China, Natasha? Why are you convinced some we talk to are and others are not?
Well, China's an interesting one. So many people have said it's uninvestable, but we really do think that this policy pivot is meaningful. The areas that how it's very coordinated, Xi Jinping has put his face and his name behind it, and that it's targeting certain areas of the economy where there is structural problems. So housing, for one, trying to tackle that, and the equity markets where we have seen. But those that coordinated effort together to hopefully lift the economy away from deflation. So those areas as a whole, we think, should continue to help support the market. And more broadly speaking, it takes out that left tail risk that we've had in China. And that's backstopping economic growth. And so how we're playing this has really been in some of those consumer stocks where we think this next round of stimulus will be more focused.
OK, that's interesting that there will be that consumer effect, because that seems to be where some people, even and certainly you speak to luxury CEOs, they're just not sure whether this is going to play out in that way for them just yet. So that's China. Thinking about Europe, I noticed from your notes ahead of our conversation, you talk about being overweight Europe on stock selection, and yet, you know, the outlook for the European economy is perhaps not great. But how do you link those two together?
Well, the macro is not the markets. It's always about the stocks. And here we see certain companies where we feel that they will continue to do well. Looking into next year, actually, the economic growth is expected to recover from quite a low base for Europe, and that we expect should help the economy to some extent. And the fundamentals and a lot of these European names that we've picked, we think will continue to flow through.
So I get that the macro isn't the micro, but to what extent do you expect that gap to close between European equities and the US if the economic picture changes, as you say?
Well, I mean, in the end, versus the US, it's hard for the European companies. I mean, for many years now, the US has outperformed Europe, and a lot of that has been just on the quality of those companies, and especially the tech sector. The margins for those tech companies have just been continuing to expand. They've had those very friendly shareholder return policies where we've seen a lot of share buyback, and the valuations, while they're more expensive, maybe more justified with those higher returns. So I think it's more of a question as how sustainable those returns are going to be in the long term to help that margin differential. That the returns differential sustain. I think that's the question, and a lot of that hinges on the AI spend. Does the next leg of AI spending in the US mean more capital intensity, lower returns for some of those big tech companies, and that will have a reflection on the market and how the market performs.
The other thing I noted was that you'd shrunk your Japan positions since the summer. We've got this election coming. Are the two connected?
Yes, there is an election coming. For the election result, we think it's very much BAU, so business as usual. Maybe you could say boring as usual if the LDP do come back in, if they're in a majority or in a coalition. We've been shrinking our positions more in the stock-specific core, and we remain more exposed to the exporters. But here we expect from the LDP to return back into government. Shiba wants to enact more radical policies of higher rates and more tax. But in the end, we think that the party politics within, there are lots of factions. He doesn't have the support. He doesn't have the popularity. And they've got an upper house election next year. All of that, I think, is going to limit what he's going to be able to do. So I think it's going to be business as usual. The rates will start to normalise slowly there. But we remain focused on the exporters, where we think that global policy put is going to help support that more broader global and macro environment.
You made a key point, which is that the United States tends to outperform Europe. That isn't always true in terms of cyclical, when there is a cyclical rebound. That's when Europe kind of gets their time in the spotlight. If Europe isn't poised in the next couple of years, at least that's the consensus here, that to outperform the United States, does that mean that we're not in a... Where are we in the cycle, I guess, is perhaps the better question.
So I think it goes back to whether I think the US continues to outperform. I think Europe should pick up because the growth is is recovering, and that should be given the more industrial focus to the market, that should flow through the fundamentals of those European companies, and you should start to see the improvement. But I think so much rests on what happens in the US. And the market's so concentrated in those tech names, whether those earnings do continue to come through, the returns aren't destroyed by or lowered because of that AI capex spend ahead. I think that's more of the key question to ask as to whether Europe does start to outperform the US. So the US has to underperform on fundamentals, I think, going forward.
Thank you very much. Thanks, Natasha. Thanks for joining us. Good to speak to you. Artemis Fund Manager Natasha Ebtehaj. Let us have a quick look at the Core 6, see how they are faring this Friday morning. Looking for any read across from the big news earnings stories we've been covering today, the likes of Mercedes, for example. Not sure it's entirely evident in this lot, though. We have some downside coming through on the luxury space. LVMH is a little weaker. Nestle also weaker. ASML a little upside, of course, on Schneider Electric and Ferrari. Let us get some individual stock moves then. Joe Easton has a briefing. Joe.
So Mercedes is declining in Germany today, and adding to the declines that we've seen over the past couple of weeks, given the warnings we've seen from the car space. Now, analysts at Citigroup writing that they are amazed by the decline in interest margins at this company, given the higher cost from their debt. So that is the worry, the margins, the EBIT margins over at Mercedes hitting the stock today, and it's falling at 2% at the moment. Then there's another big one in autos as well. This time we're over in the parts space. We've got Valeo down at 12% today. This is over in France. It's a parts maker. They make brakes, tyres, that kind of thing. And they are warning of weakness across all of their markets. So it's not just one specific market. It's Latin America, the US and Europe, according to the company as well. Then we've got Vinci. Now, Anna's pronunciation of that was much better than mine, but I gave it a go. I'm going to go with Vinci. It's down 3.8%. There is news from them in terms of them downgrading some of their guidance due to the higher tax rates coming in France, according to the company. So it doesn't look to be related to their main business, which is in airport servicing. Over in white goods, Electrolux hammered as well, the biggest drop since the pandemic days for the maker of washing machines, tumble dryers, that kind of thing. This is weakness in the US, though. They get around half of their sales in North America, competing with Whirlpool, and they have had a profit warning out of them this morning, hitting the wire. So that one slammed over in Stockholm today. Finally, a bit of green on this screen. Sanofi is coming up, given those better than expected vaccine numbers that we've seen from them. Also, some of their respiratory drugs looking pretty strong, according to that company. Then we'll check in on Natwest, because that was the best performer on the FTSE 100 in early trading, and it is continuing those gains this morning, up 4%. Bear in mind, as we showed earlier, it is up 65% heading into these numbers year to date. So it continues to be the best performing UK lender, mostly because of the overhang of higher rates in the UK market, according to analysts. Then there's a couple of downgrades to bring you. Staying in the UK, we've got SSE. This is the utility company. Now we're down to sell over at Citi on this one. They are citing a slow rollout of the offshore wind business. They don't like that stock at the moment, so they do come down to sell. And that one falling 1.7% today. Then finally, Ryanair. This one very interesting because Barclays has a note on the Irish airline. Does, of course, have shares in London as well. But they say it's got the best profit margins across the entire European airline space, and also one of the best margins in the world for the sector. So that one is actually rising 0.5% at the moment. Ryanair is a buy over at Barclays.
Joe, thanks. Joe Easton from our equities team with an update on some of those stocks that are moving. We'll get further details on the NatWest story coming up. NatWest upgrades its outlook for the year. After earnings beat estimates, we get the latest on this morning's results and a strong week for UK banks. That's next. This is Bloomberg. Welcome back to the opening trade. 18 minutes into the European session this Friday. Doesn't have that Friday feeling, though. A little bit weaker across European equity markets, weighed down by some of the earnings we've had out from the likes of Mercedes and from the suppliers to the auto sector as well. We were just hearing from Joe about how some of the suppliers in that sector looking pretty weak as a result of some earnings stories coming out there. Let's talk about the banking sector, though, here in Europe. The UBS CEO, Sergio Ermotti, is warning fragmented banking regulation in Europe is leading to higher borrowing costs and lower shareholder returns. We know that some people, or Shell, for example, have plans to change that. Ermotti told us why he thinks the economy may ultimately end up paying the price for not allowing the free movement of capital, as he sees it, between European countries.
At the end of the day, the cost is paid by the economy, by clients. I think, of course, shareholders are suffering, but eventually cost of borrowing and the facility and the easiness of accessing credit is impaired. So allowing capital to freely move across jurisdictions creates less cost for the economy.
Is there a warning from the Credit Suisse saga? You've benefited from it on the other side. Your assets have increased. You delivered earnings that outperformed expectations. There is a sense that banks that seem okay are suddenly not okay in a very fast money world. Do you worry that that's the case elsewhere?
No, I don't worry, because if you look at the Credit Suisse situation, was a very idiosyncratic topic that developed over the years. The business model was not sustainable. They didn't really have a great governance, and they benefited for too long from a regulatory concession that should not have been granted, or at least not for so long. And that was a quite unique situation. If you look at what happened back in March 2023, banks, large banks, were actually safe haven, were part of the solution, in a sense, in the US, but also with UBS in Europe. So big banks were solid, and it showed that well-designed regulators can avoid the repeat of the financial crisis. But if you go too far, then you create costs, not only for shareholders, again, also for clients. When it's going to cost more to borrow, it's going to slow down investments, and so that's not the ideal situation.
There's a saying, and it's not mine, so you can't blame me or credit me, but that the United States innovates and that Europe regulates, and that seems to be the way and the path of travel, and it's the reason why a lot of people expect the U.S. to grow really significantly and less so in Europe. How much do you see that bifurcation continue with investor flows?
Don't worry, I'm not going to disagree on that. So,
okay.
It's quite clear. You saw it in the last 20 years. Numbers talks clearly, and the underlying trend seems to go still in the same direction. There is a desire in Europe to change path. You saw with the Draghi report, with a lot of very comprehensive report analyzing the state of Europe, with a lot of ideas that, unfortunately, are going to be quite difficult to implement. The reason is that you need 27 countries with quite different interests to agree on a common goal that may result in some of them losing short term for the benefits of the long-term benefit. And in this environment, it's very difficult to get voters to support any sacrifice. And so it's likely that you're going to continue to see the U.S. outperforming Europe.
The UBS CEO, Sergio Ermotti, speaking with Bloomberg surveillance anchor Lisa Abramowitz, talking about competition between parts of the world that we perhaps know and understand. Thinking a little bigger picture, we're keeping track of some SpaceX activity this morning. SpaceX Dragon is approaching splashdown off the Florida coast. We think we're around 7 minutes away from that taking place. The capsule is carrying a team of NASA astronauts. They're coming home after completing a 7-month-long expedition. I think they were supposed to come back a little earlier than this, perhaps in September, then perhaps in October. But the undocking was delayed because of Hurricane Milton in Florida. And they are going to be landing then, Kriti, just in the sea near Florida. So we're keeping an eye on this. They haven't deployed their parachutes, I don't think, yet. But we're certainly seeing them streaking across the sky.
Well, we certainly will keep an eye on it. Of course, this is, you mentioned they were there for about 7 months as well. This is the 8th rotation they've had to the International Space Station under NASA's Commercial Crew Program. Remember, this is crucial because NASA is now partnering with private space exploration like Elon Musk's SpaceX as well. And you mentioned the 4 astronauts. 3 of them are American. 1 is actually a Russian cosmonaut as well, Alexander Grabenkin as well. So this is going to be an interesting one to keep an eye on, especially as we talk about about where this goes next in terms of SpaceX. We should mention there are still 2 astronauts that are not part of this return mission. Sunita Williams is one of them. Butch, I think Gilmore is his name. Wilmore, thank you, is the other one. They are still in the International Space Station because they weren't able to come out on that Boeing flight. SpaceX looking to bring them down as well.
Yeah, so in less than a minute's time, we're expecting them to deploy the drogue parachutes. And those 3 astronauts, the Americans that you mentioned, Matthew Dominic, Michael Barrett and Jeanette Epps. So we keep an eye for the next stage, the parachutes deploying. Then it'll be the main parachutes deploying. And then we're expecting the splashdown target time at 29 minutes past. So watch that spot on your screen.
Yes, I think they were undertaking scientific experiments, as many on the International Space Station do, weren't they? It was a scientific expedition. It included over 200 experiments. They encountered technical difficulties in September with the Starliner. That prompted NASA to bring the capsule back without a crew, and that's why we have those 2 that you mentioned, Kriti, still up there. So continue to watch that. This all part of NASA's Commercial Crew Program. The Crew 8 mission is returning important time-sensitive research to Earth.
Yeah, it's a fascinating one. We talked about some of the scientific experiments as well. Some of them that included things like tackling degenerative diseases like Parkinson's, among others, some of the plant experiments as well, talking about how they can be grown in space. Things like 3D printing was as well. They really spun the gamut in terms of where you can see some of these kind of progress being made. Also, a historic moment, by the way, for Jeanette Epps as well, who became the first black woman to live on the International Space Station. So this is noteworthy in a variety of ways.
Okay, there you see the drogue parachutes now deployed. The main parachutes come next. That should be in a minute's time. So there you can see them blowing in the space winds on your screen there.
Heading down to the seas around Florida. It's interesting. I've been talking to a lot of CEOs recently about a host of subjects, leadership amongst them and inspiration also amongst them. And it never ceases to amaze me the number of people, whether they're fans of Elon Musk more broadly or not, the number of people who find it truly inspiring to watch what he is doing and what this business is doing when it comes to space travel, space exploration, commercial activity in space as well. So, I mean, that's just one of the reasons why we keep watching this so intensely, I suppose.
Do you think it's because it's the biggest race you could possibly see, or because they're actually afraid that you might have to go and live there at some stage?
It'll be a fascinating one as well in terms of where Elon Musk goes next as well. We talk about this a lot in the context of the politics. How much private investment can Elon Musk do here? This is going to be a fascinating one. Again, remember, in just the last couple of weeks, he also was able to create that manned... I don't remember what it's called, but the thing that really kind of held the returning rocket as well. That is crucial. He's really making the case for a lot of the kind of investment from the government as well. Let's talk a little bit about the fact that we're seeing that the main chutes are now being deployed as well. They are inflating. So we are very close to the splashdown, I'm told. Fascinating moment that we are seeing on the coast, on the East Coast of the United States.
Reiterating then the names of the crew who are on board here: Matthew Dominic, Michael Barrett, Jeanette Epps and Alexander Grabinkin. I do find it also fascinating that you do have one cosmonaut on board here. There are certain parts of our economy, certain parts of our wider science community, I suppose, that continue to cooperate even when we see geopolitical tensions so extreme over the invasion of Ukraine, for example. So you've got a Russian cosmonaut on board this, and we've seen plenty of that at the International Space Station.
So just to put this into context, when those main parachutes deployed, the expectation was they would be about 6,000 feet in altitude, and the spacecraft will be moving at 119 miles per hour. So what we're waiting for now is the splashdown, and that should come at any moment currently. But when you had those drogue parachutes, that was about 18,000 feet in altitude at 350 miles per hour, roughly. So you can hear in the control room there as we watch these parachutes deploying.
Let's just focus and watch that, shall we?
Great views from the WB-57 as Crew 8 is nearing splashdown.
400 meters. Copy, 400. Meters, bracing. Copy. Copy, 200 embraced.
At this point in time, the seats in Dragon have rotated a little bit to help provide a more comfortable and safer bodily orientation for the crew members as they come closer to splashdown. Like we said before, the capsule's going about 15 or 16 miles per hour.
And splashdown.
And Endeavour, we see the same. On behalf of SpaceX, welcome home.
And as you can see on your screen, we do have visual confirmation.
Teams, what an incredible hot ride.
Again, we do have visual confirmation of Crew 8 successfully splashing down after 235 days.
We, of course, are just witnessing the splashdown of the SpaceX on the coast of Florida, a really monumental move from SpaceX, of course, bringing back 4 astronauts, 3 American, 1 Russian cosmonaut as well, back to the United States after an 8-month, almost 8-month-long mission where they were conducting experiments that tackle things from Parkinson's to 3D printing, etc. It's a really interesting time as well for SpaceX to be taking the lead on this, especially at a time we know that Elon Musk has been exploring this from the likes of Starlink as well, which really brings about not just the space exploration question, but the defense question as well, right here, back on Earth. Elon Musk really taking the charge on both fronts.
Yeah, really interesting to see. I mean, stretched fiscal budgets where governments choose to spend their money, private sector stepping in some places. We see that very much displayed in SpaceX, don't we? The ability of the private sector to step in there, certainly Elon Musk at least.
Yeah, it's a fascinating one as well. And then I think that's somewhere where we want to go next in terms of zeroing on that topic of security. It is, of course, beginning a new daily focus on the issues in Europe most at risk of disruption by the U.S. election. We are getting very, very close to the run-up to November 5th. We're going to dive deep into the topics, including trade, energy, technology, all while discussing the unique challenges that the region could face under Kamala Harris or Donald Trump. We kick it off today talking about that topic of security. We just did it in the context of defense. Let's bring in a true expert on the matter, Peter Westmacott, the former British ambassador to the United States, France, and Turkey. A pleasure to have you. Thank you so much for joining us this morning.
Good morning. Pleasure to be with you.
It is a key sticking point that you're starting to see priced in these markets of what the security mandates of a new American president might look like in regards to Europe, whether it's in terms of protection with Ukraine, whether it's the relationship with Russia, how much of those government contracts relies on the likes of Elon Musk. In terms of Europe's preparation, even the UK's preparation on the defense front for the new presidency, what are you watching out for?
Well, isn't it nice, just looking at your previous story, to see Russian and American cosmonauts has been together for all these months, coming down safely, we hope, together. So, you know, Russians and Americans clearly can do certain things together, not just, if you like, call each other out. So, no, to be more serious on this, I think what the Europeans are looking out for is what does the result of the 5th of November really mean for the future of European security, but also of the managing of the major geostrategic crises that the world is currently confronting. So you've got the Middle East, the whole Israel, Gaza, Hezbollah, Lebanon, Iran, complex of issues, very, very difficult. You've got, from the European point of view, perhaps more important than for American public opinion, Russia, Ukraine. And I've talked to Trump foreign policy experts who say these days our top priority is actually Indo-Pacific. If European security is a big problem, that's fine, we're not going to get in your way, but it's probably more of a European responsibility these days than an American one. So if you guys want to help Ukraine against Russia, that's great, but you've got to shape up and carry a bit more of the water. So there's that issue, and what will the attitude of the next United States president be to confronting Russia with its, if you like, aggressive territorial incursions into neighboring states, notably Ukraine?
It's fascinating that you mentioned that kind of China piece as well and what's going on in South China Sea, because NATO has almost a very small presence, but a presence nonetheless in the South China Sea at the moment, and almost has that European exposure to a part of the world where the Europe continent geographically isn't located. How does this affect Europe's relationship with the South China Sea?
From the UK's point of view, of course, we have something called Hong Kong, which used to be our sovereign responsibility. We also have a kind of geostrategic worldview, and we watch carefully what is happening there. We've all been bothered about the 9-dash approach, 9-dash line, which China has tried to insist upon in terms of its territorial waters, gobbling up a vast area of the South China Sea at the expense of Philippines, Indonesia, the other littoral states. So that has bothered us, if you like, in any case because of its effect on potential global security. United States, United Kingdom, Australia now have this new defense understanding called AUKUS, where we're going to be building submarines together and cooperating in terms of trying to keep the South China Sea and that whole region safer against any aggressive intent. So all that is relevant. The United Kingdom might yet even get involved in the Pacific Trade Agreement, which the United States and the other littoral states are involved in. We're not a Pacific state, but there is Hong Kong, and we've been invited to play a role there. So that could be part of the future, if you like, trade policy priorities for the UK government. But otherwise, I think it is more a question of the big global issue. How do you manage the rise of China? Where do you compete? Where do you confront? Where do you cooperate? How do you manage that relationship? It's got many more tiers to it, many more layers to it than dealing with a more simple and, if you like, in some ways more directly aggressive Russia invading a next-door neighbour.
Right.
China more complex.
Yeah, China more complex because the complexity of the interlinkages in the global economy when China is concerned much greater than the Russian story. Clearly, Russia was very intertwined with the global economy on energy and that sort of commodity, but less so when it comes to other parts of the economy. So thinking about China, do you sense, Peter, that, well, are Europeans and Americans not on the same page exactly when it comes to China? And does that matter? Will that become an issue?
United States, I think, much more important in China's eyes because of size, because America's still the world's largest economy, China catching up very fast, and that is a big challenge for the United States. For the Europeans, I'm not sure that we're on a different page. It depends a bit which government you're talking to. You remember not long ago there was a squabble between the British government led by Boris Johnson and the United States on Huawei. To what extent should we allow ourselves to be dependent on the technology of that Chinese company? In the end, we followed the same sort of line, partly because there wasn't much choice because of the availability of the components. But I think that the Europeans are nervous about complete decoupling, even though we are following a similar policy of what I'd call de-risking in terms of our dependence. Supply chains are being shortened. It's partly because of the problems we had logistically during COVID. You couldn't get stuff. But it's partly about not being too dependent on China, which might at one stage in the future wish to interfere with equipment that it supplies, whether it's technology, or turn off the tap of supplies. So I think for the Europeans, China remains very, very important. We're a little bit less nervous than America, let's say, about electric vehicles. America's talking about Trump is talking about putting 50% tariffs on EVs from China. The Europeans are not there yet, partly perhaps because we haven't got quite the same level of capability in making electric vehicles in Europe, though we're trying to get there.
I mean, there are tariffs being planned, aren't there? But they're still in discussion.
They're still in discussion,
not 50%.
and they're not 50%, precisely.
Yeah.
And we are very dependent still on a lot of Chinese components. And indeed, guess what? To keep down inflation, stuff you buy in China tends to be cheaper than if you make it at home.
So the complexity of the relationship between the EU and China might be more than EU-Russia. But the fear and the sort of very real sense that Russia threatens the doorstep of Europe is very real in Europe, isn't it? And I wonder, I was reading an opinion piece by one of our colleagues, Andreas Kluth, who was saying that the US will abandon Europe. It's just a question of when and how. You might not see it in such extreme terms, but your earlier answer led me to believe you do see quite a lot of validity in that viewpoint.
The view I take is that the United States' approach to global strategic issues, its own security, is pretty hard-nosed. It always has been. Second World War, Cold War, America looked at its own strategic interests. What matters to us? For a long time, European security and the threat from the Soviet bloc mattered. So America put a lot of resource and soldiers and weapons and finance into Europe. Today, it looks at the world, saying to itself, we can't really fight a war on two fronts anymore. We're not prepared to. The biggest challenge, not necessarily the biggest military threat, but that could come, is the Indo-Pacific and China. So that's the top priority for them. I don't think it means that America's going to give up on Europe, or I hope it doesn't, because NATO is something which is extremely important, and European security does still matter to Europe. Look to America. Look, after all, at the importance of US investments in Europe. Look at the amount of trade. Look at the preservation of such things as old-fashioned things as the values we hold dear, democracy, freedom, rule of law. Europe is still important, I think, to an America. I like to think regardless of who the next president is going to be.
OK, because I was going to ask you, Sir Peter, would Europe have a more reliable ally in Kamala Harris?
Well, isn't that an interesting question? I think what we would get if Kamala Harris was to win is a degree of continuity. Of course, at the moment, she's having to show that she's not quite the same thing because 70% of Americans believe that their country is on the wrong track, and she's got to address that if she's going to persuade people to vote for her. But it would be a degree of continuity. She has been the vice president of Joe Biden, who is an Atlanticist. I mean, he's a Zionist as well, and he's been very worried about the security of Israel, but he's also somebody who cares about Europe. So I think people would be broadly comfortable, and many of the people who the Europeans have been dealing with in the Biden team, I imagine, would be recycled into a Team Harris. I don't know who her top foreign policy officials would be, but there's some extremely talented people there who we are used to working with, who my guess is would remain there. If it is Donald Trump, I think life would be a little more unpredictable, shall we say. We don't know who the people are whom he would have there. We do know that they would be a bit more America first. But I believe that Europeans need to be realistic enough to understand that American voters care most about America's problems and don't really think it's their job to fix all the rest of the messes that the rest of us have made elsewhere. So I think there would be probably a sigh of relief in Europe if it was Kamala Harris. But I think that, you know, there are question marks about Donald Trump. I don't think he's going to try and destroy NATO. He's going to be difficult. He's going to be complicated. He may be a bit more protectionist. He loves tariffs. We don't care so much for tariffs. But, you know, it'll be a new world, and everybody will have no choice but to get on and make the best of it.
I mean, it was Conservative Prime Ministers when you were UK ambassador to the US.
Yes, and Labour ones when I was ambassador in France.
But I wonder if Keir Starmer, with his stonking majority, can afford to do a bit of a Hugh Grant impression in Love Actually, and if it is Donald Trump in the White House, stand up to him a bit more.
So far, what Keir Starmer has done is had a nice dinner for a couple of hours in Trump Tower with the candidate. Clearly a priority for him to ensure that that relationship is in good shape. There's been this little squabble, which I think has been a bit exaggerated, about whether or not the Labour Party should or shouldn't be sending volunteers to help Kamala Harris. Personally, I don't think that's a huge deal. But it does depend a bit on how the former president, the candidate Trump, reacts to that. And if he takes it very personally, if he starts to be resentful about that, it could be a little bit of a problem to handle. But otherwise, frankly, loads of Conservatives and Reform Party people are helping the Trump campaign. So, you know, why shouldn't Labour volunteers be helping? You know, I don't think that's a huge deal. So I think it'll be okay. It'll be manageable.
Talk to us a little bit about this private capital story as well. And Peter, before I ask the rest of my question, I want to play a little bit of sound for our global audience about Jamie Dimon's view on what's going on in Ukraine. Take a listen to what he had to say.
We have to be quite clear that we can't have a bad outcome there. You know, if you travel around all a lot of other nations, that border Russia, they're quite worried. You know, and some that don't border Russia are quite worried. And we've never had a situation where man is threatening nuclear blackmail.
Jamie Dimon there talking a little bit about just the geopolitics and how strong the threat is in terms of things like the nuclear threat that you are getting from Russia and, of course, the dire situation that is happening in Ukraine. The fact that Jamie Dimon is talking about that risk as one of a high priority for the financial sector, I think, is crucial at a time that we're talking about perhaps private capital playing a bigger role in this. And the reason I point this question to you is because you are also the chairman in your new role of TKO Capital here in the UK at the moment. And I'm curious, in absence of, say, a more unified defense approach from the United States and Europe, do you start to see more capital players like Elon Musk in terms of his approach to Starlink, Boeing contracts, others, play a bigger role in what the defense policy of the future looks like?
My sense, it's a great question. My sense is that the likes of Keir Starmer would very much like to see the private sector playing more of a role in addressing some of the public priorities of governments which are alarmed by what's going on in Ukraine, let's say. You've talked about Elon Musk and the extraordinary contribution that his satellites have been making to security. There are people who worry that Musk, with all his very, very strong pro-Trump noises and pro-Trump money these days, is it appropriate that he should be that much involved in government business and government security consideration? I mean, it's quite a good question. We'll have to see where that goes. If it's Jamie Dimon or whether it's my friends at TKO or others, I think that there are growing opportunities for public-private partnerships. The UK government, for example, which knows that it's got to do a better job of investing in up-to-date defense technologies and equipment wants to make partnerships with the private sector because it can't all be done by the poor old taxpayer who has got to pay for debt, never mind for future investment. So I think, especially in the defense sector, but also in certain other infrastructure areas, there is a real role for private credit, private finance, private companies to work with governments to try to deal with some of the crumbling infrastructure problems and the deficiencies of our own defensive capabilities. So I think the answer is yes, and I think I know that Keir Starmer and his ministers are very, very keen to try to develop that side of their relationship with the private sector.
Certainly something we're going to be keeping a very close eye on. A pleasure to have you on the program, as always. Sir Peter Westmacott, the former British ambassador to the United States, France, and Turkey, and now the UK chairman of TKO. Coming up on the program, we're going to go back to the stock market. Mercedes planning to change gears after lower demand in China sends its margins into reverse. We're going to take a wider look at the auto sector, perhaps continue this conversation about the China impact as well. Stick with us. This is Bloomberg.
8:48 in London. You're looking at Mercedes shares down 2.9% this morning. The lowest performing sector on the stock 600 is autos and parts. So let's get into those earnings from the car maker. It plans to step up cost reductions after fierce competition and weaker demand in China hit the luxury car maker's profits. And we can get more now from Bloomberg's Oliver Crook in Berlin. Ollie, take us under the hood. What are the standout bits of this earnings picture?
Yeah, that's right, Lizzie. We already knew from the profit warning that they issued last month that it was going to be a bad quarter. We knew overall their sales would be down 3%, largely due to China, which were down 13%. What we didn't know was just how bad the margin would be, because last year the margin for Mercedes-Benz was about 12%. Expectation for this quarter was at about 8%. What we got was 4.7%. And the margin is obviously crucial for all car makers, but particularly so for Mercedes-Benz, which has basically, as a policy, abandoned the high volume sort of game and gone just for really high margins. So seeing that in this quarter is really not encouraging for investors, which is why you're seeing the shares down now about 3%. And perhaps particularly unencouraging when you have Tesla that reported this week with a margin of 17%, right? Versus 4%. So that is going to be a very stark contrast. I also looked at the delivery numbers, and that actually Tesla delivered only 40,000 fewer cars than Mercedes-Benz. Again, putting that in the context of Mercedes-Benz, which is a company that's more than 100 years old, all of these things are going to be sort of put in focus. And of course, the market cap change in Tesla yesterday was equivalent to $153 billion. That is more than the market cap of Volkswagen, Stellantis, and Mercedes combined right now, which gives you a sort of a sense of how investors are feeling about the sector at this moment.
All right, Oliver Crook, we thank you. And let's go with that theme, because it has been an even bigger week for car makers' earnings in general. And we can break it all down now with Patrick Hummel, who's the head of autos research at UBS. Good to have you with us, Patrick. Just tell us your view after all of the results that we've had this morning on where European autos lie.
Well, they're definitely in a tough spot. We have, of course, cyclical headwinds. Demand doesn't look great for Europe. Production schedules are getting disrupted by the need for destocking. And there's also, of course, the structural element, especially for German car makers in China, where things are just going south because the local OEMs are gaining.
And do you see an upside coming in China when you've had this stimulus so far, when you are perhaps going to see a bit more strength for the consumer there? Or do you think that the focus will continue to grow on Chinese makers of their own cars?
I think China is a bit of a lost battleground, especially for the global mass OEMs. And also, as far as the premium and luxury car makers are concerned, they probably need to downsize their business. They need to right-size their local capacities, adjust the cost base. They will definitely become more niche-y over time. We think it's an illusion to defend the volumes. You have to right-size the business. You can still maintain a good level of profitability, but that's going to be limited to the niches, to the segments where they're really differentiated. These can be high-end cars with strong, powerful combustion engines, which are still a quite relevant market in China, and there might also at some point be a cyclical recovery on that front. But on, let's say, the entry-level premium segment, where you have lots of really, really competitive EVs from the local car makers, it seems a mission impossible to regain market share for the global premium car makers or the Germans specifically.
Patrick, when I look at the year-to-date performance of European car companies and those who make the parts for them, Stellantis and Valeo stand out to the downside, both of them down more than 34% year-to-date. You have the likes of Ferrari to the upside, but taking that one out as a slightly special case, Renault and Michelin actually quite robust performance, only down 4.5%. I mean, does that seem to make sense in terms of how these stories have developed this year? Is that going to continue to be the direction of travel?
I think the moves we've seen year to date definitely make sense. You highlighted Ferrari is a totally different animal. Even within the luxury space, it's a standout company with the most resilient demand. And otherwise, if you look at the other names, yeah, the parts suppliers have been hit very heavily, in particular over the last few months with the demand slowdown and the necessary production adjustments we have seen. Stellantis, you pointed out, very specifically overproduced in the US. They have to fight against high inventory, so they need to take down production, and that's hitting their margins this year very hard, in combination with high incentives for old model years that are sitting on the dealer lots that needs to be cleared by year end. So the tire space, you mentioned Michelin, they also had a profit warning on their specialty segment a couple of days ago, but still the defensive nature of the tires business, it's mostly a replacement business, explains why such a relatively safe haven has outperformed the rest of the space year to date.
Patrick, we are less than 2 weeks away from the American election, and one of the questions on the docket is simply how much more subsidization EVs may get in the United States. I'm curious about the European automakers more broadly. How much of their success, when the consumer does come back into full force, is dependent on that government support?
Well, EVs are just not profitable for the European OEMs at this point. And we have a little bit of uncertainty right now, or quite a bit of uncertainty, whether the EU will enforce pretty tight CO2 compliance rules. If they do so, we'll probably see an even lower profitability next year, because EVs are margin dilutive and some OEMs need to push their EV sales a lot to be compliant. Obviously, if the EU changes existing regulation and basically provides a bit of relief to the industry, that headwind would not be as pronounced. But right now in Europe, it's basically only Tesla that's able to make EVs in a profitable manner. All the others are struggling. There's a lot of homework to be done when it comes to the battery supply chain, because European batteries are just not cost competitive to the Chinese. And for as long as these issues are not structurally addressed, we think it's just going to be tough for car makers to really make money with EVs.
Very quickly, Patrick, talk to us a little bit about the China read-through as well. I believe we're getting headlines at the moment that there is a potential meeting on the dockets here. The Chinese top legislators will be meeting November 4th through 8th amid those stimulus helps. How much of that Chinese stimulus could help the automakers, or could it hurt it?
Right. I mean, Chinese stimulus obviously would be supportive for the market overall in China, for demand overall. We think predominantly on the mass side of things, not so much on the premium side. But let's be honest, that's not a game changer for the structural shifts we're seeing in the market. We think for the global OEMs, this, if at all, would potentially slow the downward trend, but it would not lead to a reversal of the trend. We think stimulus in autos, in the end, is not designed for helping foreign car makers. It's for the economy as a whole, and that will lift all boats a little bit. But the trend for the international car makers in China is exactly the same.
OK, Patrick, thanks so much for your time. Patrick Hummel, head of autos research at UBS. And we see stocks in Europe giving some cautious welcome to that red headline. We do see stocks having turned a little bit more, away from their extreme negativity of earlier, a little more back towards positive. But yes, it's nuanced, as we were just hearing from our guest there on the auto sector. Thinking about German car makers and where sentiment in Germany goes, we'll be bringing you the IFO data shortly. And we'll be speaking to the president of the IFO Institute, Clemens Freust, will be talking to the team about the latest survey. That takes us to the weekend, doesn't it? Let's put up what is happening across various parts of Europe. And I think this time we extend our attention even to Mexico City, because that's where the global business of the Grand Prix goes. I like that we bring something for everybody here. Arsenal versus Liverpool is for football fans and for those who just want to know whether there's going to be a lot of congestion in North London.
May I tell you what is the standout winner to me?
Yes.
The London Literature Festival. Why? Keanu Reeves is talking.
Oh.
He's got a new book. I see. I've just won this whole.
You have.
table.
I think you have.
Let's take a moment to just digest this information.
Talk about that. I don't know. It's a really exciting sporting weekend as well. The Belgrade Music Festival is one that wasn't quite on my radar, but it officially is now. We, of course, in addition to all the fun things happening around the world, Bloomberg has also recently launched the weekend edition, going deeper into the context of stories that shape markets and the world. Just you can scan the QR code on the screen to subscribe to the newsletter. That does it for the opening trade. The Pulse is up next. This is Bloomberg.